Joining us on set, Joe Lavorgna. He is counselor to Scott Bessent, Treasury Secretary of these fine United States. Happy pre-Fed Day, Joe. Thanks for joining us.
Happy Tuesday.
Yes, or Tuesday. What is your expectation from the Fed, and then what would your hope from the Fed be if they are not the same thing?
The more interesting question, Brian, is where is neutral? Where is the neutral rate? And the neutral rate is probably a lot lower than where many in the market think, because you look at the Fed's forecast and where interest-sensitive activity has been, rates should be lower. As President Trump has said, he'd actually like rates significantly lower, and you might actually need rates to be stimulative to get those old economy sectors moving. The economy is doing very well, but rates are high.
Is the economy doing very well?
It is. I mean, in the second quarter, we grew through 8. I take out federal group, it was 4.5. Atlanta Fed's looking for growth at 3.5, maybe 4% in the third quarter. We'll see what happens. The data we got this morning on hiring intentions from the NFIB was excellent. Last week, claims fell to a multi-year low. So, yeah, there's a lot of good things happening. And, of course, all the effects of the Trump policies, last and certainly not least, have yet to kick in. So you're going to get a CapEx boom, which we're seeing, a building boom on the structures because we've got full expensing. Growth should be great next year, 3% plus.
I don't know if you heard Steve Whiting last hour, but he warned that if we cut rates from here too much, more than we really ought to, that it would stoke a real bubble in AI. He said, look, the investment, the debt that these companies are raising right now, okay, it's meaningful. But he said if rates went meaningfully lower, they would be issuing way more debt. This would fuel a much bigger, he thinks, kind of frothy move, a craze to some extent around AI.
Look, the earnings in the third quarter are up over 13% in the S&P year on year. It was broadening out. When you look at the GDP accounts, it's not just AI. It's actually business equipment, transportation, industrial equipment. I mean, you're getting broad-based gains in spending. AI is part of it. A lot of the AI, too, is business to business, which is technically not part of GDP. Look, rates are high based on the Fed's own calculation. If you look at what monetary policymakers thought when they came into this year, or early in the year when tariffs were in place, we're running under 2% on goods prices. The inflation we've got is in services. Those prices will come down because we're seeing rents drop precipitously. I think that a large part is due to the border being sealed, a lot of housing supply effectively coming back online. So the inflation outlook to me is great. And my pushback to the street would be, look, the yield curve is still very, very flat. That's not a sign of inflation. Inflation expectations are very well anchored. And if we have this Trumpian CapEx boom, historically, that's been very disinflationary.
When I was on the road ahead of the election with the 5 states, all the sort of the swing counties, everybody pretty much that we talked to talked about the 2 I's, immigration and inflation. They kind of go together, to your point, okay? Some would argue that the immigration policy might raise inflation because there simply are fewer workers available for certain jobs. You can address that. But also talk about inflation. We know the president has talked about affordability. Inflation spiked during COVID in large part because you had to pay workers more to come back to work. People aren't going to take lower salaries. That would imply to me, Joe, and probably to Kelly and even yourself, I guess, that is a stickiness of which I don't know what policy could lower.
Well, here's the thing. You mentioned the I's. Secretary Bessent mentioned the I's, and let's add investment, because investment spending has been very strong. We're at a multi-decade high, decade and a half high in terms of CapEx for the first part of the year. That will increase this economy's supply-side potential. And as it relates to things like affordability, which really is not the best word, if you look at the bill, the Working Families Tax Cut, otherwise known as the One Big Beautiful Bill, it will essentially raise wages through the capital investment, through the structures in the building, 100% expensing for factories. I don't think people realize this. Normally, the depreciation on that is almost 40 years. You're going to have to depreciate a factory, or you'll be able to, in the year that you do it, and it expires in 28. So that'll create high-paying jobs in building those factories. The workers that work in those factories will have high-paying jobs. And then the no tax on tips and overtime, that will also raise after-tax wages. So you deal with cost of living issues in part by raising wages. And what we've seen, Brian, is actually through the first 9 months of the year is real blue-collar wages. They're up 1%, and that's one of the strongest readings for any new administration on record. So we're making progress. A lot of the inflation's embedded because of the prior administration. We just need a little bit more time. Gas prices at almost a 5-year low. I mean, there's a lot of good things happening, and the president's going to get on the road and is going to market that as soon as today.